Hi, everyone. Welcome. Hope you're all doing well. We'll give everyone a few minutes to pile into the room. Yusuf and I both have small children at home, so we're very much in the Halloween festivities, and we decided to come initially dressed in some costumes. So if you're
There's
a
a
fan
hint.
of, we've got Maui and Elphaba here, and just hope you're all doing well. Let us know in the chat, where are you chiming in from today? And in the spirit of Halloween, what is your favorite Halloween candy? And I'm sure I will cause fights with this. My favorite is candy corn, and specifically the candy pumpkins. Those are the best, I think.
That's wrong. No, it's got to be a Reese's cup.
We'll see. We'll see. I don't see any chats yet, so let us know on your votes there. And we've got some people who don't like candies. We've got Reese's pumpkins,
Mm.
Big Bitey's biscuits. We've got San Francisco, California, Colorado, Oregon. Lots of chocolate lovers. So while people are sharing their candy and their location here, I'll get us going with a few logistics. This webinar is being recorded today, and we will make it available on our website shortly. So if you want to come back and watch it, if you want to share it with any loved ones you think who might find it helpful, it will be posted and it will be available on our website. At any point during the webinar, you can ask questions either in the webinar chat or in the Q&A function, and I will be monitoring those throughout. We'll both be monitoring. So if it makes sense for the question to kind of come up right at the time that we're looking at something, we will ask it, we'll pause and ask. Otherwise, we'll come back to it at the end, and we'll have time for questions at the end as well. So anytime you have questions, please feel free to drop them in there. And we also have a couple resources that we'll mention throughout the webinar, and we'll post when we post the webinar on our website. They are also in the resources tab of the webinar here, so you can find those links there. We have lots of Reese's Cup fans, lots of Reese's. We've got some Twix and Milk Duds, M&Ms.
Candy corn is getting some love, though.
Yep, some candy corn. We've got Colorado, Ohio, Virginia, all sorts of locations. So with that, I will stop with my green lips and my hat, and
Cheers.
we will dive in to our presentation today, Resilient by Design. And so we're very excited to be here together today. More candy corn. I'm glad I've got some people on my team here. Usually I feel like that's a pretty divisive one. You either love it or you hate it. There's not really an in-between. So thanks everyone for being here, and let's get started. Go ahead through our agenda. So today, I'm going to start with a little bit about the actual title of our webinar today, Resilience by Design, and then we'll get into some of the things that I love, the nerdy year-end tax planning, updates on the IRS, upcoming deadlines to be aware of, and specific OBBBA, whatever you want to call it, the big bill. We're internally now calling it OBA. For a while, I was calling it B cubed. And then we'll get into the updates from Yusuf on markets, the economy, Q3 performance, comparative performance review, current events. There's been a lot happening this week. And just our general outlook as we head into the latter part of this year. So first, I wanted to just share a little bit about your sources of resilience. As I said, there's a lot going on. The headlines are swirling along with the fall leaves, and as you'll see in a little bit, the markets and portfolio are actually doing really well. But it doesn't mean that there isn't a lot going on around the world and in our country. And so just wanting to touch base on a few pieces of your specific resilience. The first and foremost being that specific to the portfolio, your portfolio is very broadly globally diversified. Over 12,000 different stocks around the world in that portfolio, and really built for that need for diversification, because you can benefit from a lot of the best things happening and mitigate risk from other things happening. And so that is something that we believe to be fundamentally important to investing, and it is how all of our portfolios are invested, our own personal investments as well. And it's a really important piece of that resilience, is that broad diversification, because you're not overly exposed to any one specific thing or trying to outsmart the market, which we don't think anyone could do. We are harnessing deep regularities in a very grounded and policy-based way. The second piece of resilience I want to touch on is cash. And so for everyone, your cash in your emergency fund is a really big source of resilience. And so if your emergency fund isn't fully topped up, that's a really important place to focus first with any additional cash. Get that emergency fund topped up. And then we'll talk a little bit about your stable reserve. So for our clients who are in the accumulation years, the bond portion provides some what we often refer to as dry powder. And so in the event of a downturn, which we know will come, we've lived through many downturns, we will live through many more. It is a fact of life and investing, they will happen. We don't think although the economists disagree, we don't think anyone can predict exactly when or why they'll happen or how long they'll last. So it's about having that resilience. So for our clients who are in this accumulation phase, in the event of a stock market downturn, the bonds become a larger portion of the portfolio. You can sell bonds and buy stocks at lower prices, buy them on sale. We all love a good sale. For our clients who are in the spending phase of life on the safe spending system, that is very much not the case. There is a hard firewall between bonds and stocks in the event of a downturn. And so for our clients in that spending phase, you may recall that every 6 months, we top up your cash to a full 12 months worth of your cash need. And most of you have 30% in bonds in addition to that. And so that cash and bond stable reserve is really intentionally there for the eventual downturns that will come. In the event of that downturn, we would raise cash only from the bond portion of your portfolio because, like we know downturns come, we also believe in human ingenuity and resilience and know that the recoveries will come. So it's about being able to weather that storm, leave the stocks completely alone so that they can participate fully in that recovery. And that bond, that cash and bond stable reserve will bridge you through 6 to 7 years worth of a downturn before we'd ever even have to think about selling stocks at depressed prices. And this is not predicting a downturn at any point, simply providing that there is very intentional resilience built into your portfolio, both in that broad global diversification, in our cash needs policies, and in that stable reserve for spending clients. And then the third piece that I'll share is that financial planning is a verb on purpose. It is planning. It is not, here is your financial plan, have a great life, because life doesn't work that way. By the time we give you a financial plan, it's already wrong because life changes. And so financial planning is a very adaptive process. It is iterative, it is ongoing, it is a lifelong process and relationship. And your financial plan specifically is stress tested. So you may recall, if you've seen the tornado chart, the Monte Carlo simulations, your financial plan is run through 10,000 different scenarios with all possibilities of inflation and market returns, and looks at what are the probabilities of success. And that's how we give you what we believe to be that sustainable spending, that the path that you're on. And so it is stress tested and it is adaptable to whatever comes. And we're meeting frequently to update it and to say, hey, here's where things stand now. Are there course corrections needed in either direction? Either, whether that's, hey, things look even better than we planned. What flexibility does that give you? Or let's talk about maybe we're on a different path. What course corrections need to be made? So today we're going to focus on kind of two topics that relate to some of this resilience. First and foremost, kind of managing the tax realm of the financial plan. So some deadlines coming up and actual year-end tax planning work that our team is working vigorously on right now. We started our year-end tax planning in early September. And so that's a big part of our season right now. And then we'll talk a little bit more about the portfolio. What's been happening? What are the outlooks? What are all the things we're paying attention to? Because we're thinking about you all the time. All the time we're thinking about what can we be doing? What do we need to be doing? Are there changes needing to be made? We're paying attention to what's going on so that we can answer questions as they come in, have these conversations around what's going on, because we do get a lot of questions. We all see the headlines, we see the predictions being made, we see what's going on. And so we want to make sure that we're always available to address those questions and talk specifically about your sources of resilience. So with that, something that maybe was not resilience is the IRS's relationship with paper checks. They are breaking up. The IRS will no longer be issuing or accepting paper checks any longer. And so this part of this is to streamline processing. And so refunds will all be done via direct deposit. One bonus, it's much quicker. You put your information in, you file, you get your direct deposit pretty quickly. It's not the same as waiting for a check in the mail, going to deposit it. All of your estimated tax payments and tax payments due will also need to be made electronically going forward. Don't worry, it's very simple to do online. We have an entire step-by-step process for you. It is linked here. That will be linked in the PowerPoint that we share when we post this on our website. But we also have a specific article that walks through each of the steps, has the images. We're always happy to help, send instructions. So that's just a quick update about IRS and paper checks. And with that, we will get into some deadlines as we approach the end of the year. I cannot believe it's almost November. Truly, it happens every year, but I can't believe it. But some big upcoming deadlines to be aware of. The first one is, depending on where you live, property taxes. So in Virginia, most counties' property taxes are due December 5th. In California, the due date is November 1st, but the actual deadline for when penalties or late payments start to happen is December 10th. And so most people are paying their property taxes in that first week of December. So make sure you check your actual property tax bill. Don't listen to my dates. Look at your actual bill. Make sure you've got the dates right and make your payments there. One question that I just saw here, a question just back to the IRS checks. As of September 30th, the IRS is no longer issuing paper checks. In true IRS fashion, they have said, well, we're not really accepting them, but we don't have specific guidelines of exactly when we will say absolutely not, you may not send a paper check. So all of the tax professionals that we work with have recommended strongly of going immediately to all the electronic payments to meet the deadline. So as of now, future payments, so when you have January 15th quarterly payments to the IRS, those will need to be made electronically. When you file your 2025 tax returns in April or sometime between April and October of 2026, you'll need to put in or provide your bank account information to your accountant to get any deposit or any refund deposited directly into your checking account. So back to some other deadlines, FSA reimbursements, so flexible spending accounts. If you have a flexible spending account or a dependent care flexible spending account that allows you to get pre-tax dollars to pay for childcare, those reimbursements have to be done within your employer plan year. And so one of the things about this that's wonky is that it's not by default a January to December plan year. For example, the Yeske Buie benefits year is from October 1st to September 30th each year. I was talking to somebody yesterday, their open enrollment is July for an August start time. So knowing your employer year is really important, because if you have expenses that you can submit for reimbursement through your FSA, you want to make sure you do so as soon as possible and do so within your actual plan year. Now, there are two caveats to that. A lot of plans provide a 2-month grace period where you can submit expenses that were incurred during the actual plan year and still get reimbursed. Some plans offer a very small rollover if you don't use them to the next year, but the plans cannot offer both of those. So they can only offer one or the other, and any funds you don't use are use it or lose it. You do not get them back. So really important to meet those deadlines. Make sure you're submitting those reimbursements on time. Personally, I have to have a system set up so that I don't forget. Otherwise, I assume December 31 and I forget the dates. So putting a system in place, make sure you know when to submit those reimbursements. Similarly, 529s. 529s are a January to December 31 timeline. So any expenses that you incur for qualified education expenses that can be reimbursed from a 529, you need to reimburse yourself within the same calendar year. So if you paid a tuition bill in March and you haven't reimbursed yourself from the 529, make sure you do so before December 31st so that they're both in the same calendar year. And then two other things we'll spend more time talking about later in this, but just that your required minimum distributions must be done by December 31 each year. Same thing for any qualified charitable distributions, which are checks directly from your IRA to charity, have to be done by December 31 to count towards your required minimum distribution for this calendar year. And charitable contributions as well. Any charitable contributions you plan to report on your deductions on your tax return must be done by December 31. And there's a caveat there that December 31 is the date, but many of the organizations and custodians have much earlier cutoffs. So a lot of the donor advised funds, for example, you need to make donations by December 1 or December 15 to make sure they can process everything in time and get it coordinated for this calendar year. Same thing if you're sending checks to charity, you want to do that early enough that they have time to receive those and cash them and all is in good order before the end of the year. So we'll talk more about both of those a little bit later with some of the year-end tax planning we're doing specifically, but those are just a few deadlines I wanted to share. So now my favorite part. I think every time I am on a webinar, I talk about how nerdy I am about tax planning and how much I love it. It's a really fun time of year. It's chaotic. There's a lot going on, a lot to think about, especially in these tax law change years. So we're doing a lot of year-end tax planning reviews right now. I'm actually going to go in reverse order here, the bottom of the slide first. We are always doing our usual year-end tax planning, and the biggest analysis we're doing for that are Roth conversion analyses. So oftentimes if clients retire before required minimum distribution age, there may be some really low income tax years where we can have a conversation around potentially taking advantage of lower income tax brackets. Roth conversion is where you take money out of an IRA, pay taxes on it in that year, convert it to a Roth IRA where it grows tax-free forever. And so it can make a lot of sense when you're in these years before big required minimum distributions kick in, maybe before Social Security income. You may have really low earned income years and low tax brackets to take advantage of. So that's something that we review every year for every client, especially if we know something major has changed or if we're in that phase of years before RMDs kick in. And then this year there's an added layer. So the OBA, Big Beautiful Bill, was enacted earlier this year, and there are some specific things that go into effect this year and next year that we're looking at. The biggest one where we're seeing some potential action actually needed are regarding charitable contributions and potential bunching of charitable contributions, because starting in 2026, there is a 0.5% AGI floor before you can deduct any charitable contributions. And so part of what I have to share with you later is actually an example of what those numbers look like. The senior deduction and increased SALT deduction, there's not a ton of specific action to take on these. It's more of looking of if you will be receiving additional deductions because of these new deductions that are part of this bill. And so we'll get into some examples on both of those as well in the coming slides. But first, I will turn my light back on. And first, I want to talk about AGI, because always the tax code, there's a lot of jargon, there are a lot of rules, there are a lot of specifications. Many of these changes in this recent tax bill, these new deductions, are subject to income phase outs. And when we say income phase outs, or when the bill says income phase outs, most often it is referring to AGI, which is your adjusted gross income. And your adjusted gross income really is every source of income that you have. So that can be dividends and interest, that can be other portfolio income, earned income, wages, self-employment income, IRA distributions, pensions, Social Security, all of those sources of income. And rental income would be another one. And then it's reduced by what are called above the line deductions. So there are certain deductions that are above the line, and they are called above the line because they are specifically above this calculation for AGI. And so some of the main ones are IRA or deductible IRA or SEP IRA contributions, the deductible portion of self-employment taxes, and deductible self-employment health insurance premiums. And so when you look at your actual 1040, you can see the line here. This is your adjusted gross income. So all the sources of income above, there are a couple schedules it references that have additional income and additional deductions, those above the line deductions. And that is what equates to your adjusted gross income. So most of these new deductions that we're talking about and new credits like the child tax credit, other pieces like that are limited by various forms of income, most often by your adjusted gross income. And so when we talk about first the increased SALT deduction, SALT stands for state and local taxes. So those are the income taxes you pay to your state where you live. Those are sales taxes you pay, and those are property taxes you pay to your state and or county for owning property in the state. Previously, from the last big tax law change of 2017, the TCJA, Tax Cut and Jobs Act, the state and local tax deduction was limited to only $10,000. And for many clients in high income tax states, this was definitely felt. So for clients certainly in California, New York and DC are also significantly high income tax states, and Virginia as well. We have lots of clients in Virginia. If you were paying before $40,000 or $50,000 or $60,000 of state taxes, even 15 or 20, you were able to deduct all of those, subject to some other limitations based on AGI that were much higher limitations before phase outs. That got cut to $10,000. So now that limit is up to $40,000 temporarily, only for the 2025 through 2029 tax years. And it is subject to AGI phase outs. In 2030, under the current tax law, it will revert back to $10,000. One thing you may notice is that some of these expiration dates are at certain times in political cycles. I would imagine that there will be more tax law change in the future. I always chuckle when they're like, these have been made permanent until the next tax law change. But as it stands, this $40,000 maximum is 2025 through 2029, will revert back to the $10,000 maximum in 2030. During this period, that $40,000 maximum is subject to AGI phase out. So if you are single, file single, if your AGI is below $250,000 and you pay at least $40,000 in state and local income taxes, you can deduct that full $40,000 maximum. If your AGI is above $300,000, you will only be able to deduct that original $10,000 maximum. If you're in between, it's a sliding scale. It will phase down in between. And so the same idea for married filing jointly. If your AGI is below 500,000, you can deduct up to the 40,000 max. If it's above 600,000, only the $10,000 maximum. And so we'll actually look at some examples here. For the first one, in all three of these examples, we're going to assume a couple married filing jointly. So in this case, let's assume the couple has $240,000 of AGI. Their total possible deduction inputs for this state and local tax, so that could be state income taxes and property taxes, is $31,000. Under the previous law, so in 2024, in the last year since 2017, they would only be able to deduct $10,000 on their itemized deductions for this state and local tax section. Now they get the full $31,000. The second one would be what I've dubbed the no change situation. So this is a couple who has AGI of $650,000. So recall the maximum, that top of the phase out was 600. They're at 650. No matter what their state and local tax actually paid is, they will only be able to deduct that same $10,000. And then the third situation will show you someone in between. So in this case, the couple has an AGI of $555,000. So roughly in the middle of that $500,000 to $600,000 range. They paid $60,000 in these various inputs. Prior deduction was $10,000. New deduction will be $24,000. So these clients, the left and the right scenarios here will see a change in the itemized deductions from prior years, and the middle column will see no change in that case. And so I have a question here coming in about sales tax, actual or an estimate. Usually the reporting for sales tax would be actual sales tax paid on various items. So most clients will only deduct that in states that don't have income taxes, because usually your income taxes are going to be big enough to get up to that amount. But your accountant will be able to tell you any proof they need for various sales tax pieces there to add in if it will help you get up to that limit. So next we will talk about charitable contributions. I mentioned bunching earlier, and I specifically didn't explain it because I knew this was coming. I knew I'd be talking about this bunching. So bunching is where you take, let's say you give a certain amount of money every year to charity. Bunching would say, let's take 3 years worth of charity, for example, and bunch it and do it all in 1 year. Most often this is done through a donor advised fund. So a donor advised fund is a charitable account that you are a donor advisor for. You can give 3 years worth of your charitable giving into that donor advised fund. You get to take a tax deduction for the entire amount that you gifted to that donor advised fund this year. And then you can actually grant out the money over any number of years that you want. And so it can also be doubly powerful because you can gift appreciated securities, so appreciated shares of the mutual funds you own, for example, or stock maybe that you inherited. You can gift that to the donor advised fund. And as long as the shares, you've held them for longer than 12 months, you get to deduct the fair market value of the shares on the day you give them, and you never pay taxes on the capital gains. And because it goes into a charitable account, charities don't pay taxes on capital gains. When it is liquidated to give out your money to the actual charities, there's no tax there. So there's a really nice tax benefit to doing it. And if the charitable intent is already there, it can be a really powerful way to get some additional deductions in the current year before that 0.5% AGI floor kicks in next year. One of the really interesting things is that, as I said, we've been really busy in doing these reviews. There actually aren't many clients where this big charitable bunching is making sense, because I think first and foremost, a lot of clients are of required minimum distribution age. And so in that case, doing qualified charitable distributions, which do count as part of your required minimum distribution and come out of your IRA tax-free to charities, you get a dollar for dollar deduction that way, no matter what. And so that's looking to be the most powerful way for most clients who are of required minimum distribution age to give to charity. So that's one way. The other reason is that this new standard deduction is so much higher that so few families are actually itemizing deductions. So again, that's where the qualified charitable distributions can be really powerful. And the other piece is that the 0.5% AGI floor, while it's not nothing, it's not as significant as some other itemized deduction floors. So for example, medical expense deductions, you can't deduct anything until it's over 7.5% of your AGI. That's a much bigger floor. In this case, 0.5% it may not be a significant amount. And with some of these new deductions, we'll talk about like the enhanced senior deduction, you may not actually notice much of a difference during this time period, but we're still looking to make sure that we are giving the best advice to each individual situation. So I'm going to give you an example of this one that I shared in a recent article we did. So some assumptions first. This client, we're going to assume these clients, it's a couple married filing jointly, giving $10,000 a year to charity already. They have $24,000 in other itemized deductions. So that might be state and local taxes, that might be mortgage interest, that might be medical expenses, whatever the other deductions are. So $34,000 of total itemized deductions, and they have an AGI of $300,000. And so in this case, we'll look at two examples. The first one is scenario one. And so this assumes that this client couple just continues to gift their $10,000 a year to charity as they have been doing normally, no changes. So in year one, 2025, you can see that they take their itemized deduction of $34,000. Because the standard is $31,500, their itemized is higher than the standard deduction. In 2026, you'll note they have the exact same total deductions, but they can only actually deduct $32,500. And the reason for that is 0.5% of their AGI, which is $300,000, is $1,500. So their charitable deduction of $10,000 is actually only $8,500 on their itemized deductions. And so we go from 34 to 32.5. Now, 32.5 is still higher than the $31,500 standard deduction, so they're still itemizing. In scenario two, instead, this would be a bunching scenario. So in this scenario, they're going to give $20,000 to charity this year. So again, maybe it goes to the donor advised fund. They give out $10,000 this year as end of year gifts. They give out $10,000 in 2026 as end of year gifts. So in 2025, again, they get to take a deduction for the full amount given to the donor advised fund in 2025. So their deductions in that year would be $10,000 higher, so $44,000. And then they would skip deductible charitable giving in 2026. It's not that they're not giving, they can still dole out the grants from the donor advised fund to the charities that they wish, but the tax ramification is that there's no deductible charitable contributions in 2026. In that case, instead of their original 34, it would be $24,000 of potential itemized deductions. And in that case, the standard deduction of $31,500 is higher. And so they would take the standard deduction of $31,500. And so if we look at this specific case, the total deductions in these scenarios is not nothing. There is a difference here. In scenario one, it's $66,500 total between the 2 years. In scenario two, it's $75,500 total. So a $9,000 difference, and you can do your math, but depending on states, that's a $2,000 to $4,500 worth of tax savings over 2 years. And so it's not nothing if logistically it's feasible to do this charitable bunching strategy. So this is something specifically that we are looking at for clients who are giving to charity, who are going to be affected by this 0.5% of AGI floor next year, and seeing whether it makes sense to do this strategy, or if they are of required minimum distribution age, whether it makes sense to do the qualified charitable distributions. And one of the pieces that I'll chime in on here that is not part of my examples, but the other thing we're looking at is 2026. Starting in 2026, if you take the itemized deduction, so in example 2 here, scenario 2 here, you do give some cash gifts, there is a deduction for up to $2,000 for married filing joint couples for cash contributions to charity if they take the standard deduction. So these clients could even do something different where they would do $42,000 to the donor advised fund this year, $2,000 in cash next year, and everything else from the donor advised fund. Or if it's a client doing qualified charitable distributions, $2,000 in cash in 2026, any other charitable giving from qualified charitable distributions from the IRA. So that's something that we are looking at and making notes of. And so, if we have your tax return, we're doing analysis, we'll let you know what we think, if you need to take action or if you don't need to take action based on these changes. So next, the enhanced senior deduction. And this is another one because nothing can be simple. This is for the 2025 through 2028 tax years. It is up to $6,000 per person who is over 65. This is, I'll skip down my bottom bullet. This is in addition to the already existing other deductions for clients or for taxpayers who are over 65 and or blind. Right now, those deductions are $1,600 per person over 65 or blind. And then it's $2,000 if the person is single and has never been married, so not a surviving spouse. And so this is in addition to those numbers. And these ones are subject to income thresholds. Now, yet again, the IRS cannot, and tax law change, nothing can be simple. These income thresholds are based on your MAGI, and that is your modified adjusted gross income. And the main piece that is different between AGI and modified adjusted gross income is that the modified AGI adds back in what would otherwise be excluded under foreign earned income. So for most families, the modified adjusted gross income is the same as AGI. So for purposes of my coming example, we will simply use an AGI number. But in this case, to show you, to explain in my mind, let's take a single client. So very similar to the previous threshold I was sharing. Single client, AGI of $50,000, person is 66. They're going to get that full $6,000 enhanced senior deduction. Single client, age 66, AGI is $125,000. They'll get about $3,000 of that senior deduction. Single client, age 66, AGI is $200,000. They will get none of this enhanced senior deduction. And so this is one that there's not really much specific action that we would recommend anyone take, but we are looking at it in our analysis to see what, if, and how much clients may be expecting of this starting this tax year, 2025. And this is a table from one of my favorite resources, kitsis.com, just showing if under the various AGI thresholds we spoke about and taking standard deduction, these are the maximum deductions that these specific scenarios could get. So a single client who has never been married, who is over the age of 65 and taking the standard deduction could get $23,750 of standard deductions starting in 2025. A married couple, again, who is under those various AGI thresholds we talked about, who is taking the standard deduction. One spouse is over 65, so they get that already existing $1,600 for being over 65, plus the full $6,000 for being over 65. That's a total of $39,100 for these deductions. And then on the far right side here, both members of the couple, both over 65, they get the full $31,500 of standard deduction, the $3,200, so that's $1,600 times 2 of the current age 65 plus deduction, plus 2 of the $6,000 enhanced senior deduction, so up to $46,700. So again, for clients who are over 65 and have AGI under these thresholds, there may be a noticeable difference in deductions for 2025 through 2028 tax years. So those are a lot of pieces of what we are looking at, what we're analyzing, and what we're doing as part of our year-end tax planning, in addition to the usual Roth conversion analyses, making sure that required minimum distributions and qualified charitable distributions are complete. So and one of the things I meant to say in the deadline slide earlier, for any accounts that we're directly helping you with at Schwab, we are making sure that those required minimum distributions are satisfied. And we're often doing so in the first quarter of the year, unless you have monthly distributions or you want to give charitable contributions later in the year, or there's some other specific reason to wait. Most of the time, we're completing those early in the year. We're monitoring throughout the year, running reports, making sure those are done. And same goes for inherited IRAs. If you are subject to RMDs under the old rule or under the new 10-year rule, we're tracking those, making sure those are getting completed. But if you have retirement accounts that are outside of our purview or what we can see consistently, make sure that your required minimum distributions are done on time. And if you need help processing those or how to request those or filling out paperwork or determining tax withholdings, please let us know. And let us know if you need us to set reminders to help you track that year after year. And we're happy to reach out and make sure that that's done each year.
Well, thank you, Lauren. My turn to jump in here. Dare I say Maui time, if I can reference the costume from earlier. And so you've covered so much of the tax law changes, and in that spirit, kind of figuring out how we can empower our clients to be most resilient with their cash, given that taxes affect cash flow. For me, I'll be talking about the portfolio as per usual, and we'll start with just a look at the most recent quarter. Here we are in October, almost at the end of the month. But if we can look at how things played out from July, August, and September of this year, the chart here demonstrates a pattern that we've been seeing all year. International has stolen the show as it relates to performance when compared against the investments that we manage for our clients in the US. Here's your S&P 500 fund in the top third, and yet bested by both international large value and international small value. And it's here that we'll remind you, and for those of you who tune in regularly, you're probably tired of us saying this, but we'll say it anyway. We tilt the portfolio in favor of small company stocks and value stocks. And so whenever we're ranking the performance of the various investments, when we see small or small and value at the top of the heap, that's good news, especially for our clients' portfolios. Now, we'll note that there are some US funds here kind of creeping up towards the top. And however, their performance in this particular quarter, not good enough to change the story for the year. So, chart that looks similar, but you'll note the scale is different across the bottom. This is performance from the beginning of the year through October 28th. Again, note the scale. This is not a typo and not a joke. The International Small Value Fund in our clients' portfolios is up 43% year to date. International Large Value up by 36%. International Small, International Large, both up by more than 30%. And then here's emerging markets at plus 25. The next best performing position or fund is that S&P 500 fund, doing just fine at plus 18. But we'll share here that if you add the performance of all of the US focused funds here, we'll ignore global real estate for a second. All these together add up to the position's performance that we're seeing just in international small value. And so we'll say this as a reminder. We diversify for a reason. No one had it on their bingo card for 2025 that international small value would be up by more than 40%. And yet, being diversified as we are, maintaining that global focus, being globally neutral, we're gratified to be able to report that our clients have been able to benefit from this performance throughout the year. Lauren, do we have a question?
We do. You read my mind. So a really good one too. And I think you might get to some of this in a couple slides, but I want to ask it here because I think it's a great image just to ask how much of, or talk a bit about how the international performance is influenced by changes in the US, in the value of the US dollar, and maybe expectations for the trend, that trend going forward.
Yeah, we do have a specific slide about the dollar's performance, but we'll make the point here. We do not hedge our investments against currency rate fluctuations. So what that means is if the dollar is weakening, when we convert performance or returns from international positions back into dollars, if the dollar is worth less, those returns are worth more in dollars because you get more dollars for whatever currency you're converting in from. Good news on the dollar, by the way, it's held pretty steady for the past 6 months. And again, we'll talk about that when we get back to a further slide. But to that question, yes, if and when you see the dollar as weakening relative to other currencies, that's not necessarily bad news for your portfolio, especially when international investments are performing as well as they have been for this year. And it hasn't just been for this year. We're going to look at a few other slices of time. We'll go 12 months backward. These are real returns, and you'll note that the S&P 500 has lagged all 4 of our major international funds over the past 12 months. If we go further back and we look at the 3-year average annual returns, your S&P 500 fund has been doing quite nicely, plus 22% average year over year, and yet it gets a bronze medal for that period. Because in second place, you have international large value, and there's that international small value fund again at the top of the heap. Again, just demonstrating how powerful the performance over the past year has been and how that's changed the narrative. The narrative has been, and perhaps depending on, when you're watching the news, you're probably still hearing about how the S&P 500 has been dominant. International small companies don't get a lot of airspace, or take up a lot of space in the headlines rather, and yet when the performance is this good, we make a point to emphasize it. And finally, we'll look back 5 years. So this is going back to October of 2020. And that's prior to, if you remember, for those of us who live in this space, I'll call myself out. Markets took a huge ramp upward in November of 2020 because two things happened. We had the release of vaccines, we had a presidential election, and a lot of uncertainty around two of the most pressing issues at the time was resolved or clarified. And given that, markets love when uncertainty goes away, and they took off. So this captures that performance. And what you're seeing here is from the end of October of 2020 through the end of October of this year, 5-year average annual returns. Listen, plus 17, plus 18%, nothing to sneeze at. But we're in fourth place here with the S&P 500. And so just pointing out that the news that you may be hearing or reading may not be giving you the full story. And so we want to make sure that our clients fully appreciate how all of the components of their portfolio have been performing rather, and we're gratified to be able to report that being geographically neutral, being globally diversified, has certainly benefited our clients this year.
So Yusuf, before you move on, one thing, I loved your bronze medal, right? It's everyone still won, right? This
Yeah,
is all good. The
that's right.
performance been great everywhere, and I love the explanation of the diversification and the geographically neutral, which leads into a great question that just came in about this. The question saying, okay, so based on this, do you make modifications and put a larger percentage of our investment dollars into international small value when you see this happening?
So it's not something that we change on a frequent basis, but we do review frequently. So every quarter we look at a report that shows us how, various portions of the market have been performing, and then how much space each of those portions is taking up. And we just did this reporting. We got the breakdown on October 17th. I, as I do each quarter, sent the report on to the rest of our partners here earlier this week or last week, I believe. Regardless, the point being is that as of the most recent print, international developed markets take up 27% of the space in the global market. For our clients' portfolios, international developed markets represent 32% of the space as far as stock investments. So we're tilted a little bit in favor of international right now. And again, our clients' portfolios have benefited from that. But the reason we've done that isn't just because we wanted to guess or that we guessed right or we saw good performance earlier in the year and so we loaded more into that portion of the portfolio. At the top of the year, we looked at two things. Number one, that breakdown, how much space were each of the components taking up? Number two, how expensive were those various components? And because US large stocks, specifically those that you would find in the S&P 500, are so expensive, relative to their long run averages. And because international stocks relative to their long-term averages are priced averagely, if I can make up a word, we thought it made sense to maintain a slight tilt in favor of international. But we won't make changes unless we see that those proportions have crossed specific tolerance bands that we've set around every region around the world. So we're disciplined in how we evaluate how much to allocate towards the various regions. We talk about it frequently, and then when it's time to make a decision and make a change, we will. But given this performance, we haven't made any changes thus far. We'll continue to evaluate, and if we make a change, certainly we'll communicate that.
Yeah, and one thing that I think you were just sharing, Yusuf, is that we're very policy based, and so when these various pieces of the portfolio are doing really well, if they grow above their tolerance bands, we're actually selling them back to target and buying things that are below target. And it's hard to do emotionally because you're selling something that's made you really happy and buying something that hasn't made you quite as happy, but it's the policy-based implementation of buying low. It's of buying low and selling high. And so that's, that's one of the things that we can take the emotion out of, is running that, for client accounts, we're looking every 2 weeks, and it's look frequently, trade infrequently. It's only if things have Pierce
Right.
tolerance bands, but the things that are doing best are growing as a portion of the portfolio, and they need to be trimmed back down because we are so intentional about what we think the weights of the portfolio, of the positions and pieces of the portfolio should be. Speaking of which, I got a question in here, so there's some great stuff coming through. One about how are the 10 funds distributed in our portfolios. And so one of the ways it's different by allocation, whether how much you have in stocks and bonds, the actual percentage in your portfolio is going to be specific to that and everyone who has that model. But within the stock portion of the portfolio, it is the same across the board for all clients,
Yes.
for our own personal accounts as well. And the place that you can see that is actually on your client private page. If you log into your client private page, and if you've lost your credentials or you're not sure what they are, email us, we'll send them to you. You scroll to the portfolio reports section and you open your reports. And so you can open the global report, which is a conglomerate of all of your accounts together. So you can see your entire portfolio in one, or you can open individual account reports. And if you scroll to the first page, you'll see the big picture overview of how much you have in stocks, large company stocks, small company stocks, and bonds. And then if you scroll to the second page, you will see the actual mutual funds within those sections and their weights. And so that would be the easiest way to answer your question specifically, Jim, of how yours are distributed in your portfolio. So that's that, and I'll reach out to you too, and I can send that. And so there also are some good things coming in, Yusuf. I know this is coming up, and just about how the S&P 500 has some pretty significant players that are taking up a lot of weight. AI, tech, Mag 7, here it comes.
Oh, you mean this slide?
And so just, it was more a comment of the
Mm,
S&P being pretty dominated by a few
yeah.
players.
Yeah. Yeah. So perfect segue.
And actually, Yusuf, can I go back
Yes,
one before we jump into this? If you go back to your previous
absolutely.
slide, maybe.
Yep.
There was one question that came in. So our US international split is about 60-40, and you were talking about the actual reality. So the question is, what is the reality of that split right now?
Yeah, it's pretty spot on. So you know what? I'll go back to this slide because it has all of our stock mutual funds listed here, and we can talk about the different percentage weights allocated to each one, and then we'll talk about how that translates to the global splits. So for any fund where you see international, each of these 4 funds carries an 8% weight in the stock portion of our portfolio. So 8 plus 8 plus 8 plus 8, 4 times is 32%. Again, that compares favorably or is a bit tilted in favor of international relative to the global market. The global market, international developed markets represent 27%. If we look at emerging markets, the current split is, I have to back into it.
Emerging markets and global real estate are 7 each, Yusuf, because unlike our CIO, I have to have the list in front of me to remember the exact percentages every time.
Yeah, 7% for those 2 funds in our portfolio. We're short on emerging markets on purpose because we do not invest in China. If you include China when you think about emerging markets, I think the split's at like 12 or 13%. If you back it out, it's like 8.4. And then for our US splits, the US in the global market represents 63%. In our portfolio, it's 61. We call that close enough. We get some from the exposure in the global real estate fund, and then the remainder is split fairly evenly between the 2 large funds and the 2 small funds. 13% for the S&P 500, 14% for US large value, 13% for the US small fund, and 14% for US small value. So fairly close in terms of the global splits relative to our portfolio. And again, where and when we see discrepancies that pierce our internally defined tolerance bands, that's when you'll see us reallocate. But we're not anywhere close to piercing those right now, even with the appreciation of most of the recent performance.
And then okay, 2 more. We've got good questions today. I love
This is
it.
great.
Keep them coming. One here was a comment, but I have some thoughts and would love your thoughts, Yusuf. Is just one of the comments that it seems like the NASDAQ annual return has been higher than the S&P,
Mm,
apart from 1 year. And I think, that makes sense because the
yep,
NASDAQ is almost exclusively tech focused, 100 companies. And those tech companies with AI included is certainly a big part, but AI is not the only piece of tech. Tech has
right,
done really well. And the S&P 500, while there are 7 to 10 companies taking up a huge portion of the returns, there are 490 others that some are tech, some are not. They're all different
right.
companies. And so that disparity would make sense between the two. Would you agree with that, Yusuf?
Absolutely. Yeah. I mean, this is sloppy math. But to your point, those massive companies, call them the Magnificent Seven. We'll see if I can name them all. Amazon, Alphabet, Meta, Nvidia, Netflix, Tesla. Who would I forget? Amazon. How could you forget Amazon? Bezos is mad at me right now. They represent like 33% of the S&P 500. Now that's 500 stocks. Within the NASDAQ, you've got 100 stocks, and they're going to take up a bigger proportion there.
Mhm.
So where those stocks are dominating by way of performance, you'll see them push the NASDAQ up by that much more, given the fact that they take up that much more space.
Yeah, and I think I read recently the next three in the S&P 500 bring that up to 40%. So 10
Mm,
out of 500 companies make up 40% of the index right now. So there's just a big weighting of their performance. All right, so one more right now that we have, just back to the comment on how our emerging markets fund excludes China. The
mhm.
question being, would you consider including China going forward?
Well, the issue there has nothing to do with China as a country or Chinese people, but it has to do with reporting guidelines. So the People's Republic of China reports information differently from the way that we do. And there's just a lack of transparency in that information. And therefore, we fundamentally believe it is necessary to run a portfolio for our clients that we can explain with confidence, no matter how granular the level of detail is. And that's just not available in terms of the information being reported by China right now. And so that's why we've excluded Chinese investments from our portfolio.
Yeah, and I would say it's not a never say never. If that
Sure.
changes, certainly that would be something we talk about. Another question here that I'm gonna propose a resource, and then we will link it when we post this webinar. So there's a question about, are there other decisions like this about excluding China from the portfolio? And we have a piece on our website called Stable Not Static about our
Hmm.
portfolio. We are very grounded and consistent. Our investment philosophy and our worldview has been that way forever. But it doesn't mean that we have blinders on and we're not making changes. Yusuf is
Right.
paying attention all the time. We are talking about it frequently. We are making sure that what we are doing is in alignment with how the world actually exists, thinking about interest rates. So there's a piece on our website called Stable Not Static that talks about some of those changes in the portfolio that have been made in alignment with the world actually changing. So whether that was going to really short-term bond funds when interest rates were at zero and had nowhere to go but up, whether it was shifting around the percentages of emerging markets to make sure that that was reflective of the world actually, of how much the emerging markets make up of the world market. So there's a piece there, and we will make sure we post it as one of the resources under this webinar when we post it on our website.
Yes, absolutely.
All
We
right.
good?
Yep.
Good. All right, let's get to talking about bubbles because we've been getting this question a lot. Clients calling in saying the market feels frothy. How could it possibly be performing this well? We hear so much about AI and how much those companies that are investing heavily in AI are dominating market performance. But isn't that a concentration problem? Are we diversified against that? And of course, the answer is yes, by the way. Um, Here's the thing. We're not going to call the AI bubble a bubble because we can't know if something is a bubble before the fact. And we're not in the business of making predictions. We appreciate that it may look like one, it may smell like one, but it has not yet begun quacking like one. And so we're not going to call it that yet. With that being said, we do appreciate that some of the numbers out there are a bit dizzying. You've got Nvidia out here as a $5 trillion company. You've got Elon Musk demanding a $1 trillion pay package. um, and so, I mean, these are numbers that feel and sound absurd. And in a lot of ways, they are. On the other hand, if we're going to compare this to the dot-com meltdown from 25 years ago, some of the counter arguments are also really sound. This is different. This isn't pets.com, right? This isn't fake companies coming out of nowhere with no real assets. The Magnificent Seven, those companies, massive as they are also entrenched in our economy and in our marketplace. They have real products. We all buy them. See, here's an iPhone. Um, and here's the thing, they have track records. So it's not like there's no there. And we can see that there is a bunch of concentration in that area. And what we're happy to report is that those 7 companies are present in the S&P 500 fund that's in all of our clients' accounts, and nowhere else. So you're well diversified. There are 12,000 stocks in your portfolio. So 7 being massive, then there are 12,000 other ones that are also invested elsewhere. Um, and so here's the thing, and we've been talking about this for some time. If you've been listening to these webinars, we've been talking about tech and how there's more and more concentration and why diversification matters. We can't predict the future. We're not going to call bubble, and we're not going to predict a popping of any bubble. But if we can use the dot-com meltdown as a point of reference to compare where we are today and how our portfolio performed after that bubble popped, and we can call it a bubble because looking back historically, that's real. Do not take this as a prediction, but rather a source of comfort. A diversified portfolio can perform quite well in a situation where one portion of the market becomes overvalued, gets too hot, and then kind of comes down to earth. What you're looking at is a chart that shows the average annual returns over a 6-year period from January 2000, and the dot-com meltdown started in about March of 2000, through December 2005. The meltdown kind of ended at the end of 2003, and then you have a couple of years of recovery in here. We were intentional about showing both the downswing and the upswing because we do very much believe, as Lauren mentioned earlier, if markets take a hit, we are going to see them recover. Your S&P 500 fund averaged an annual return of -1% through that 6-year period. -1, 6 years straight. Contrast that against your International Small Value Fund, which averaged about 18% per year over that 6-year period. So what carried the portfolio through this period, and this is much of what's often referred to as the lost decade, from 2000 to 2009. What carried the portfolio? Well, the things that we tilt our portfolio in favor of: small company stocks, value stocks, or as the case may be, small value, whether it's international or domestic. So again, yet another reason why we diversify. We don't know when things are going to go sky high or come crashing down to earth in markets. We know that both things will happen. So we want to be positioned everywhere. And that way, no matter what happens, we can confidently say to our clients that your portfolio is positioned well for whatever may come.
One quick
Questions?
thing I'll note on the resources, we have that stable, not static. Just posted that link there. Again, we'll post it when we post the webinar, but it is also on the resources tab here if you want to grab it now. There's two other questions that we've had come in, and being mindful of time, Yusuf, did you want to go through other pieces and then we can come back to the questions at the end?
Yeah, let's do a lightning round update on tariffs and trade deals, given that negotiations came to a truce between the US and China while you were sleeping. We're just going to summarize 9 trading partners on this slide here. Lightning round. European Union, trade deals done. China settled on a 1-year truce yesterday. Japan, done. United Kingdom, done. Canada, off. If you read anything about that Ronald Reagan World Series ad, great. If you haven't, look it up. It's interesting stuff. Brazil, apparently there's a trade deal that's been guaranteed, as reported by President Lula, but no deal done yet. Mexico, negotiations ongoing. South Korea, trade deal done. And India, close, but not yet done. So that's encouraging, given how much tariffs and trade and all that has roiled markets kind of at the early part of the year. We seem to be getting to a place where things have calmed down a bit. Quickly here, I mentioned this earlier, but just to show you a busy chart, because it wouldn't be me if I didn't. The US dollar seems like it has settled. It's been hovering around 99 on the index, 100 is baseline. That's really all you need to take from this chart. And so I'll go to the outlook slide, but as a placeholder, and ask Lauren, What might we need to cover in terms of questions?
So one will relate to, I know something coming on this slide. Question that came in is the Fed has lowered interest rates without
Sure
getting the
did.
current stats on CPI and employment. How do we think that that lack of information will affect the markets?
Yeah, so there's an expectation that when the government reopens and we get this backlog of data about the employment story or unemployment story, that there may be some weakness or softness in the labor market. And that may further motivate the Fed to cut rates. Um, but we just don't have the data. So it's something that we'll watch and remains to be seen. Um, were there more questions or should we click through?
There's one more here, just kind of back to we were talking about the Magnificent Seven, the top 10 stocks in the S&P 500. Just a question of if is there any historical difference? Is the dominance of a small number of companies right now? It's tech. You know, we saw a
Mm.
lot of the same in the 90s, late 90s, leading up to .com. Is the dominance of those small number of companies in various US stock indexes any different from historical figures back in the 50s, 60s, 70s?
I think by order of magnitude, this is a bit unique. And however, we've seen visuals, and we can get this one and share it with folks. The folks at Dimensional do this where they kind of rank the biggest companies in the market over different decades. And every decade, the top companies change. So maybe a note to find that visual and share with our viewers as a follow-up. But um, it's always different, but it's kind of always the same.
All
All
right.
right. Lightning round on Outlook. Inflation at 3%. We'll see when we get the next print. Not making light of the fact that the government is shut down, but we're not going to get any information there probably for a while. Unemployment, as of the last measure, we were at full employment. Full employment is an unemployment rate of 4%. We'll call 4.3 close enough. Economic output, despite the doom and gloom that you might be hearing about on the news, the U.S. economy continues to grow at a healthy clip. Quarter two, annualized growth rate of 3.8%. You can round to 4. Estimates on the third quarter, call it 4% as well. And finally, as we mentioned, the Fed did cut rates yesterday. They may well cut rates again later this year. They have one more meeting in December. The present rate is 3.75%, and we will see what the cost of capital will be come December.
And one more that I'll add in, just that Yusuf and I were talking about before we got started, reading some news updates. I saw that the average mortgage rate in the US has come down again this week to the lowest in a year. Still at 6.17% for those of us who have had mortgages in the 2% range, it seems very high, but it is at the lowest point it's been at in a year. And so that's another one that we just keep tabs on and see what's happening there.
Yeah.
If there are any final questions, feel free to chat them right now or throw them into the Q&A session. I'll give a couple seconds there for any questions. And of course, if you have questions after the fact, if you want to follow up on something, email any of us and we'll be happy to respond back with our thoughts. Thank you all so much for joining us today. You will see this recording posted pretty soon on the website with all those resources we talked about. And hope you all, if you are celebrating Halloween, hope you enjoy your candy, enjoy decorations, enjoy scaring children, whatever it is that you may like, carving pumpkins, watching scary movies, which is not my cup of tea, so I will not join for that. And enjoy your weekend. And just thank you so much for being with us today.